This is Matthew Cratter from Trader University, and today I want to answer the question, has Bitcoin failed as an inflation hedge? Now, we might start by just asking the question, why should Bitcoin be a good inflation hedge anyway? And I would argue that it's a little bit like digital gold. This is what I've been talking about for the past year and a half or so. And like gold, which is another historical hallowed inflation hedge, Bitcoin is quite scarce, and scarce things are a great way of preserving your purchasing power. Truly scarce things, which is another way of saying they're a good way of being an inflation hedge. So, for example, beachfront real estate, there's only so much beachfront real estate in every country and in the world, so it's a very scarce asset and a very desirable asset as well. You can take fine art like Picasso or Monet, where the supply is limited by the fact that the artist is no longer alive. You could also take rare editions, for example, the original Star Wars comic books. These kind of things tend to be a good way of preserving one's purchasing power. Now, one of the things that everyone knows about Bitcoin is that there are only going to be 21 million Bitcoin. This max supply cap is very easy to enforce because it's impossible to get everyone who's currently involved in Bitcoin to agree to a higher supply. So everyone who runs a node, you could create your own software that has Bitcoin with a supply of like 22 million or 23 million, but no one is incentivized. No current Bitcoiners would be incentivized to join you because they would be diluting themselves. So this is a credible cap. And Bitcoin, unlike Ethereum, has had this very steady, very credible monetary policy. It hasn't changed. It hasn't changed it many, many times like Ethereum has. But the thing about Bitcoin is there are not just 21 million because many have been lost. No one knows the exact number, but estimates are something like 3 to 4 million have been lost where the owners no longer have the private keys, and so the Bitcoin is no longer able to be moved. So we have this very, very scarce asset. It's a digital asset, which is what you want in a digital age. And then you contrast it with something which is the opposite of scarce, which is fiat money. The potential supply of US dollars is infinite. And this isn't just something that I've made up or that I think. This is what the Fed, which is the Federal Reserve, the central bank in the US, this is what they also think. As Neil Kashkari told 60 Minutes about 2.5 years ago, there's an infinite amount of cash at the Federal Reserve. Especially in a crisis, they're very happy to print as much money as they need to. And by doing this, they dilute the value of the US dollar, and scarce assets go up in dollar terms. We also have the famous Bernanke speech from the early 2000s, the printing press speech, where Bernanke wrote that the US government has a technology called a printing press that allows it to produce as many dollars as it wishes at essentially no cost. And this is, of course, the digital printing press now, where it's the marginal cost of producing an extra dollar is basically zero because it is just zeros and ones. It's digital dollars. And when we end up with CBDCs, it'll be something very similar. It will not have a capped supply or maximum supply like Bitcoin does. So fiat is the opposite of scarce. Bitcoin is very scarce. This suggests that Bitcoin has the potential at least to be a very good inflation hedge. The kind of comment I've been seeing for the past few months, and the one that I want to address in this video, is comments like Dan made 3 days ago. Buys Bitcoin to hedge against 10% inflation. Bitcoin goes down 75%, but yeah, if you bought low, you're good. So this is the critique. We're going to have to talk about something called the CPI, which is the Consumer Price Index. This is a weighted average. It's a basket basically of consumer goods and services that's picked by the government to try to be sort of representative of the average American household's spending habits. Of course, everyone has their own basket of goods and services that they pay for. People without children, for example, may not pay for school or children's choice, something like this. The CPI stands for Consumer Price Index. So let's talk a little bit more about this critique of Bitcoin as not being a good inflation hedge. It's very strange how this argument is made, and people don't realize that they're not being internally consistent. And this is what Dan did as well. So what happens, and it's not just Dan, it's a lot of people commenting like this on my channel. So the first thing the critic does when making this kind of argument is he or she picks the very top of the Bitcoin chart, the all-time high from November of 2021, thus implicitly assuming that everyone bought their entire position at the top tick, the intraday high, and did not instead dollar cost average over a series of days and weeks and months and even years. So they'll pick that top price Then they'll glance at Bitcoin's price today. So the top price was something like 69,000. The price today is something like 19,800. They'll glance at those and they'll see that huge negative return. And then they'll take that number, that negative return, and compare it to a 3-week-old CPI number. We haven't had a CPI number since the beginning of August. And that CPI number is a measurement of 12-month inflation. So what they're doing is they're basically comparing a 9-month return in Bitcoin since last November's peak to a 12-month government inflation number. And Bitcoin has obviously fallen quite a bit in the past 9 months, but there's something logically inconsistent here. If you're going to pick your starting and ending points, they should be the same. And so then the conclusion is reached that Bitcoin is a terrible inflation hedge. So there are a couple important points I want to make about this. The first point is that Bitcoin is not a pure hedge against CPI inflation. And this might shock you for me to say this, but I'll show you what I mean by it. A pure CPI hedge would be like a derivatives contract of some sort, either a forward contract or futures or options contract that would make you a fixed amount of money for each 1% move in the CPI. So this would be a pure hedge. Let's say, for example, the market expected 5% CPI inflation for a certain government data announcement, or over a certain period of time, you expected 9% CPI inflation, and then you'd have this derivatives contract that you enter into, which pays you out that difference. It pays you out that 4% difference multiplied by some notional amount. So if you had a $10 million portfolio, you could enter a $10 million notional amount, and you could make that 4%, or however you wanted to structure it. It could be structured in an infinite number of ways. This would be a pure hedge against CPI government figures. It'd be a bet exactly on what those government announcements are going to be, and it wouldn't be concerned with what possibly the real inflation rate is. It would just be concerned with what the government announces. Now, if you're a large hedge fund, and I've seen this, it's pretty easy to get your prime broker, which is where you place your trades. It's the group like Goldman Sachs or someone like that you place your trades with, and you custody your hedge fund's money with. It'd be very easy for them to write a contract like this, to design a derivative like this for you. Unfortunately, it's not really possible for the retail investor. I'm not sure it's the greatest idea either, because you're betting on a highly massaged, manipulated number, as we're about to see now. So the second point is that this is a famous saying, there are lies, there are damn lies, and then there's statistics. I would say there are lies, there are damned lies, then there are U.S. government statistics, then there's Chinese government statistics. And in the process, we move further and further away from the truth. And the CPI, being a U.S. government statistic, really is worse than a damned lie. As we will see, the way that it's been calculated has changed many times over the years. And every single change to the methodology, how the basket is calculated, has miraculously created a lower reading for inflation than if the old methodology was used. How convenient to keep changing, to keep moving the goalposts, to keep inflation looking lower than it actually is. Now, this used to be considered a conspiracy theory. Even 2 years ago, it was considered a conspiracy theory. But now, even the mainstream media, the benighted New York Times, admits that it's true. And I'll link an article about this. Here's a great example where there was a change that was made, I believe, in the 1980s, where they went from using home prices to using owner's equivalent rent, which is a highly statistic that's fairly easy to manipulate, and it does also understate the actual cost of living in a house or renting a house. And so if we were still using the old way of calculating inflation, it would have hit as high as 12% at the beginning of 2022. Instead, it was closer to 8% or so. So all of these changes to CPI have always made the inflation rate lower. This is another reason you would not want a pure hedge on CPI, on the CPI number, because it can be manipulated, it can be changed. Now, if you've been following closely, you'll notice that this actually is something that hurts my case, since I'm arguing that this is a massaged government statistic, the CPI is, and we all know that the actual rate of inflation, as we all experience it, is much higher than the CPI. So it's even worse if the CPI, the real CPI, the true rate of inflation, is higher, then Bitcoin has been an even worse inflation hedge than it would appear to be. So what's going on here with Bitcoin? Is it an inflation hedge or not? Before I explain this to you, I just ask you, if you're finding this video helpful so far, to hit that subscribe button hit the like button, share this video with a few friends. So what's going on with Bitcoin? Is it an inflation hedge? Well, it certainly appears to have compounded much faster than CPI inflation with a nice extra margin. So if we look at 1 year out, it has not been obviously a good inflation hedge, down 60%. And again, that's assuming you bought it 12 months ago, right at the peak. But if we look at the 2-year returns for Bitcoin, up 91%, we certainly have not had CPI inflation of 91% over 2 years. So however you want to calculate that, 45% a year or whatever. 3 years, up 86%. 4 years, up 101%. And we'll see that it's outperformed gold. It's outperformed the S&P 500, starting with the 2-year time horizon, not the 1-year time horizon. And then if we look all the way out, obviously the further you go out, you get very, very large outperformance numbers. So for example, over the past 9 years, I would say that inflation in the US has not been almost 16,000%. So it has been a good inflation hedge if we just sort of eyeball it over the past couple of years, if you begin with the 2-year time horizon. Another way of looking at this is you can normalize consumer prices of goods and services you buy using Bitcoin, and you can use government data to do this. So for example, the Fed releases the average price of bread, cost per pound in a US city. This is white bread that's served in a pan, etc. And if we normalize this for Bitcoin prices, in other words, we divide by the price of Bitcoin, we can see that it has plummeted over the past 5-6 years. We could look at the max amount. I think that's the max. We could look at the 10-year, the 5-year, and we can see that the fact that this chart is going down means that bread in the U.S., the average price of white bread, is going down in Bitcoin terms. So Bitcoin, if you're holding Bitcoin, and you don't have to worry about the price of bread going up because your investment returns have more than compensated for it. So we could do that with white bread, we could do that with eggs, and all of these charts are crashing because the price of Bitcoin has been appreciating faster than the price of eggs, and so they've been a good inflation hedge. We can see, for example, eggs since the beginning of 2022, and Bitcoin has not been a very good inflation hedge, just over an 8 or 9 month period. But when you start to look at multi-year periods, you can see how well Bitcoin protects you if you are a future buyer of white bread, a future buyer of eggs, or even a future buyer of houses. So if we look at the median sales price of a house sold in the US normalized for Bitcoin, houses keep getting cheaper and cheaper in Bitcoin terms. Even if we look at the 5-year chart, we can see housing prices have gotten cheaper. If we look at the 1-year chart, we will see that Bitcoin has underperformed housing prices. Now, of course, there's a lag in housing prices as well. Bitcoin is much, much more volatile, but this chart looks roughly like the chart of eggs and white bread. There's a nice tool that I want to share with you here. It's a website called dcabtc.com that allows you to calculate your return if you had been dollar cost averaging over a certain period. So rather than being quite unfair and saying, well, everyone bought their Bitcoin at 69,000, and so everyone's down 75% from there, this gives you a more accurate idea of what would happen if you were dollar cost averaging in Bitcoin over time. So you can pick the amounts. What I'm going to do, I'll link to this calculator in the description notes below, so you can do this exercise yourself. But we can try something like, for example, what if we had purchased $10 once a week for 6 months, starting 6 months ago, and we would see that the total amount of fiat that we put in was $270. The current value of that fiat is $267. So that is a return of about -1% over 6 months. So not nearly as bad as if you pretend everyone bought their Bitcoin at 69,000. That being said, not a very good inflation hedge because we've had inflation over the past 6 months. Let's call it roughly 4 or 5%. So it has not been a good inflation hedge over the past 6 months. Let's take a look. What if we change this and we say we accumulate for the past year, starting 1 year ago? In that case, we invested $530. It is now worth $490. We're down 7.5%, while inflation has been, call it 8 or 9% over the past 12 months. So again, not a good inflation hedge over that period, but nothing too bad. I mean, being down 7.5% on your investment, you haven't kept up with inflation, but you're not exactly wiped out. And this is why it's so important and why I've always advocated for dollar cost averaging Bitcoin. Now let's say if we look 2 years out, and again, if we look 1 year out, if we look 6 months out, we are measuring Bitcoin returns over a very short period of time in a very deep and brutal bear market. And so that's one reason perhaps to look at a longer time horizon. So if we do 2 years out, doing the same thing, buying $10 worth of Bitcoin every week, accumulating for 2 years, starting 2 years ago, we invested $1,050 over that period of time. It's now worth more than $1,300. So that's a 27% increase. That looks like it is definitely, even assuming 10 or 12% CPI inflation. The actual rate's been lower, but let's say the real rate of inflation is closer to 10 or 12%. In that case, we've in Bitcoin, dollar cost averaging into Bitcoin and hodling it has definitely been a good inflation hedge. And I don't need to go through all these numbers. I'll do 3 years ago just as one more measurement. I would say that inflation in the U.S. has been less than 145% over a 3-year period. So I think this is the more fair way. This is what Bitcoin hodlers actually do. They dollar cost average in over time. And so this is a better way of representing Bitcoin returns rather than assuming everyone bought it at 69,000 or whatever convenient starting and ending points you pick in order to make Bitcoin look bad. So here's the larger point of this video. Inflation hedges need to be measured over years or over decades, not months or weeks. And the important thing is no one asks other inflation hedges to do this inflation hedging over a very short period of time. So no one says that gold doesn't work anymore because it hasn't hedged inflation over the past 6 months. I would imagine gold is actually down over the past 6 months, just like Bitcoin. No one asks stocks or real estate to do this either. And no one blames their financial advisor because their stocks did not go up as much as the gas prices at the pump over the past 12 months. Everyone understands that when you're investing for your retirement, when you're investing to preserve your purchasing power, either by buying a rental house or buying bonds or buying stocks or buying Bitcoin, that this is a long-term process that needs to be measured over years. Even stocks will not protect your purchasing power. Gold will not protect your purchasing power over 6 months or even a year. So the problem is people who hate Bitcoin, they always want to apply a different standard to Bitcoin than they do to other asset prices. But there's no one measures the price of a Monet or a Van Gogh or a Star Wars comic book or beachfront real estate. These other inflation hedges, no one measures them over 6 months. You obviously have to take a larger view. Unless you hate Bitcoin, people like Peter Schiff who say Bitcoin isn't an inflation hedge, etc. And he's always saying this, but he of all people should be the one who should not be saying this, because if we look at gold as an inflation hedge, over the past 10 years, it's only up 1%. And that's not 1% a year. That's a total up 1% in total. So we've certainly had more inflation than just 1% over the past 10 years. So the one thing Peter Schiff can never answer is why gold has been such a lousy inflation hedge over this period. Obviously, there's been a lot of manipulation of it using paper gold, and I've talked about why this would be much more difficult to do with Bitcoin to suppress its price. But if you're going to go after Bitcoin as an inflation hedge and you're a traditional investor, you're a gold bug, you still have to answer for yourself and for your investment in gold, which is looking pretty terrible. No matter what time period you look at, you'd be better off being in stocks in the S&P 500 or being in Bitcoin. I wanted to make a couple final notes. I mentioned this at the beginning, but I want to make it very clear because sometimes people get confused. There are two ways of thinking about inflation, and it really depends what you put in the numerator and what you put in the denominator. You can think about inflation as just the price of stuff going up, the price of goods and services going up, even the price of fixed assets like houses going up, for example. You could also think about inflation as the purchasing power of your currency going down. These are two different ways of saying the same thing, obviously. Now, gold, as we said, has been a good way of protecting purchasing power. Another way of saying it's been a good inflation hedge, not really for the past 13 years, but over longer periods of time, it has been a good a good way of protecting your purchasing power. It's been a good inflation hedge. And the example people always use, if you bought an ounce of gold, if you had an ounce of gold in the 1800s, it bought you a nice men's suit, and today it still buys you a nice men's suit or a horse. There are various different analogies that people use. And as we said, it hasn't been a very good inflation hedge since 2009, probably because I would say, for one thing, the invention of Bitcoin, obviously, in 2009, and also simply because we've entered into a much more digital era where people want digital goods like stocks and Bitcoin. They're much easier to use, to send around, to store your wealth in. A digital age, as I've said many times, demands a digital store of value, and physical gold really failed us. It failed us by leading us to the fiat standard, and it was sort of inevitable because gold is so difficult to move around. And so people stored it in centralized places, and it got confiscated by governments, and they issued paper money against it. And this was sort of the transition to fiat, which became really final in 1971 when Richard Nixon closed the gold window. So over the past 3 to 10 years, people holding Bitcoin have gotten richer relative to everyone else. And then the $1 million question is, will this continue? I think it will, but only time will tell. As we began this video, they're good first principle reasons, sort of reasoning from first principles. There are these reasons for thinking that Bitcoin will continue to preserve and grow investors' purchasing power. In other words, be a good inflation hedge. So it has its scarcity, its digital nature. It's very easy to move it around the world, unlike gold, for example. And Bitcoin is very censorship resistant, unlike Ethereum or Cardano or XRP or some of these more centralized coins that are subject to capture, as we've talked about many times with Ethereum on this channel. Now, there are always going to be people with high time preferences and short attention spans, and these people will continue to criticize Bitcoin's performance over very short periods of time. But these kind of people ultimately do really badly in their own investing, simply because they're focused on very short time horizons. And Bitcoin really is an investment for the next decade, and it's important to dollar cost average in it, and it's important to continue to hodl it. So these superficial critiques of Bitcoin as an inflation hedge, I think you can safely ignore them. If we've gone for 5 years or 6 years or something like that, and Bitcoin has really underperformed inflation, then we will know that something went wrong. And the problem with this, of course, is that you'll only know after it's too late. But I do think this is not something, I'll emphasize, it's not something I'm worried about. I think that the credible monetary policy of Bitcoin and its scarcity and its really unique launch into the world, this immaculate conception, make it a very unique asset and something that should continue to perform. You're not going to have the same high performance that you had in the early years, but Bitcoin should continue to go up still, on average 100 to 200% a year, and probably even higher once the Fed turns the money printers back on and we enter a more hyperinflationary phase. If you've enjoyed this video and my teaching style in this video, and you're interested in learning more about Bitcoin, you want to go even deeper down the rabbit hole than I'm able to do on YouTube, I'd encourage you to check out my paid courses, which I'll link to below, especially the Ultimate Guide to Bitcoin, where I go much deeper into the theoretical underpinnings of Bitcoin. I also include a lot of practical lectures. So for example, how to buy Bitcoin anonymously. I have 5 lectures on that. How to run your own Bitcoin node for free. How to connect your wallet to your node. How to connect your Trezor hardware wallet to your node. How to use the Cold Card hardware wallet, and also how to create your own multi-sig vault so you don't have to rely on outside providers like Casa or Unchained Capital. Some of these companies, you can actually build your own multi-sig vault. Also how to do coin join and how to give yourself better forward privacy using Bitcoin. So if this is something that interests you, I'll put a link in the description notes below. You can also check out all my other online courses that are available at Trader University Premium. These include a lot of trading courses, how to trade options, how to trade futures, the basics of stock trading, and especially one of my specialties and one of my favorite things to do, though not in the current Fed environment, is to trade momentum stocks. And so I have some advanced lectures on momentum stock secrets, how to make money with IPOs, swing trading with options, this sort of thing. So you can check that out in the description notes below. I'll put a link. You can browse all these courses. And if this is something that you're interested in, you'll just scroll all the way down to the bottom here and click Get It Now. That will take you to the checkout page. And because you've listened for this long, I want to make sure you get a special coupon code. You can go right down here where it says have a coupon code and type LABOR, LABOR, because it's Labor Day weekend in the US. and I wanted to give you a code related to that. Labor 22. We just click update, and normally access to everything is just $125 for 30 days access to all the courses, something like 15 courses there, including the course on Bitcoin. But if you use that coupon code Labor 22, you will get $28 off, and instead of paying $125, you will only pay $97 for 30 days access. You can cancel at any time. There are no long-term contracts or tricks like that. So this is something, once you've exhausted all my free content on YouTube and you want to go a little bit deeper, I encourage you to check it out. And again, I'll put a link in the description notes below. Thanks a lot for watching. If you found this video helpful, please give it a like, subscribe to my channel, share this video with a few friends, and leave your questions or comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.